So here's FHA loans. FHA loans, they're backed by our government and they're easier to get pre-approved. And that's why a lot of like first-time home buyers start with an FHA loan. FHA insures the mortgage and are more willing to give you a loan with lower qualifying requirements, which makes it easier for you as a buyer to qualify. This is for your buyers. So maybe they had some challenging credit, some things that came up, a divorce or, student loans that were past due. As long as, I've gotten a loan approved with as low as a 560 credit score. Showed that they started making payments on time on their debt, that they weren't in, they just didn't have collection. We could even get an FHA loan with no credit scores. We just have to have some sort of other credit. Like we could show that they've been paying, let's say, a utility bill for the last 12 months, or that they've been paying rent, or their auto insurance, or their phone bill, something along those lines. It's called alternative credit. So they could have no credit and still get an FHA loan. It says it costs less. FHA loans have competitive rates because the loans are insured by the federal government. Always compare an FHA loan with other loan types, because here's the biggest loan. So conventional, they're stricter. They want you to have higher credit scores, just to be more settled in your job, in your home, that you're not bouncing around at different addresses. But they're never going to charge you something called upfront mortgage insurance and a conventional loan. Basically, you'll have to pay mortgage insurance if you don't have 20% down. But on an FHA loan, they're always going to charge you something called upfront mortgage insurance. And on an FHA loan, that is 1.5% of your loan amount. So if you're doing, let's just say 500,000 times 1.5%, they're going to charge you $7,500 and add that to your principal balance, just at the very top. The borrower does not have to come up with that money, but they will add it to your principal balance. So when we're calculating your payments, that's going to be a factor for you. Besides that, you have monthly mortgage insurance that you'll be paying, and you do not have on a conventional loan. So I always mention that, to my borrowers. I want them to know the difference. And then that's why we'll look at maybe FHA loan interest rates are lower than a conventional loan, but you're going to pay that $7,500 on a $500,000 loan. So you have to do the math on it. Is it worth it to get a lower interest rate and have to pay $7,500 up front? Or what if you're putting 20% down on an FHA loan and you're still having to pay that monthly mortgage insurance plus the upfront mortgage insurance? Is it worth it? It may not be. It may be better to pay a little higher interest rate and not have these extra fees in your loan. So USDA loan, they're really good loans because you don't need any money down, but they're also really strict. It's primarily for low income individuals or households purchase homes in rural areas. So here's the pros and cons on this. Rural housing program offers the following important features: 100% financing. You can ask for 6% seller's concessions, and there's no maximum loan limits. So you can do this on a $2.3 million property. There's no loan limit. That's a big deal. There are 30-year fixed rate mortgages, and it must be in a non-metropolitan area. Well, Hawaii has lots of areas that are like that may qualify for a USDA loan. Single family, and it has to be owner occupied homes. It can't be like duplexes that you're gonna, or townhomes where you're gonna try and, rent one side out, things like that. They won't allow. The best part on this is if appraised value is above the sales price, you can actually use the difference for concessions or repairs. So let's say you made an offer at 1.2 million. And when we did the appraisal, it came in at 1.4 million. Those $200,000 can be used for repairs or paying for closing costs. So that's a good thing, because I don't think there's any other loan type that allows you to do that. So to me, that's a big deal. Program provides low and moderate income rural residents with better access to affordable housing, financing options with little or no down payment or out-of-pocket costs. So I think the key is going to be low and moderate income rural residents. Borrowers may obtain a loan to purchase a new or existing home in a designated rural area. The population of 10,000 or less, a population of 20 50,000 or less if located outside a metropolitan statistical area. Eligibility, borrower must lack sufficient resources to obtain conventional financing. So I really need to touch on that because I have a client right now that has $50,000 to put down. And when we were running, they have their own, USDA has their own automated system and it's called the GUS system. And when we were running her loan through there, it asked me if she had funds. And when I put $50,000 in there, it told me that she was made a USDA loan because she could most likely be approved to do a conventional loan. So it's kind of a catch-22. Your income is low enough to qualify for a USDA loan. And by the way, they do have a webpage that you can go to. It's usda.gov to see if their income is eligible and to see if the property is eligible. And then also on USDA, they're also going to look at your household income and not just the people who are on the loan. So we have multiple families living together. And just because it's mom and dad on there, but you have your adult child and maybe a grandparent, they will also look at their income to see if you're going to be eligible for a USDA loan. Questions on that? No? Okay. So occupancy. So it has to be a primary residence and it's for 30 years. We also can do a rate and term refinance once you have a USDA loan. And then this is a government-backed loan, but remember that 1.75% upfront mortgage insurance that I told you we would charge on a FHA loan? Well, a USDA loan has something like that, but it's called a guaranteed fee, and that's at 1% of the appraised value, not the purchase price, but of the appraised value. And then they also have something called mortgage insurance, but that is a lot less than on an FHA loan. I believe it's 0.35% versus 0.50% on a FHA loan. So they will have some sort of monthly mortgage insurance, but not as much as an FHA loan. So VA loans,
But
I know that
I have a question because
yeah.
I worked with USDA loans before, and I know it's primarily on the west side, but according to this, it's on in a rural area. So,
Yeah.
like, are there other areas on the island that are considered for USDA, like on the east side or in like Kailua Kaneohe?
So that's why you want to look it up in their website, and it's usda.gov. And there's a little tab at the very top and it says property eligibility or income eligibility. If you click on the property eligibility, you can punch in the address or even put the area that you want to look at, and it'll tell you, yes, this area is eligible for a USDA loan.
Got it. Okay.
Okay. So VA loans, I think those are probably our favorite types of loans to do. I know they are mine. VA guaranteed loans are made to eligible veterans for the purchase of a home. It's 100% loan. It's guaranteed, by our government, and they don't have to pay any mortgage insurance monthly or upfront. Basically, the government says you've already, taken care of us, so we got you. We got your back. You don't have to pay for any down payment, any type of mortgage insurance. So, of course, that's a great feature for them, and that's why so many veterans they can move around and they can use it. That some people think, oh, once you use it once, you're done. You can't use it again. You can. There's entitlements, and I've even seen them have multiple properties on a VA loan because they were stationed. One guy was stationed in Michigan, and he purchased a home there, and then he was going to move to Colorado, and he was going to purchase a home here. And actually, my nephew did the same thing. California, he had a VA loan there and moved to Colorado, and they actually allowed him to use his VA benefits because he still had some. He still had some entitlement, and he was able to purchase another home here and ended up renting the other one. You cannot buy it. You cannot use it to buy a rental property, but you can use it if you're getting transferred or relocated, and it's going to be another primary residence. So I thought I'd mention that. And as far as their debt ratio, they aren't as strict as conventional. They'll allow us to go up to like 50% debt ratio, 55% debt ratio, and they're still going to get an approval. It just depends on, what their credit scores look like, compensating factors. VA loans offer the following essential features. Of course, equal opportunity for all qualified veterans to obtain a VA loan. No down payment, which we talked about already. Buyers informed of reasonable value. And the other thing is, unless required by the lender or the purchase price is more than the property's reasonable value, there's no down payment. So how, like, a few years ago, everybody was offering more than what the property was worth. On a VA loan, they were allowed to do that, but we had to see that it was reasonable in order for us to move forward on that. Interest rates, they're pretty reasonable. So you're going to have the lower of conventional for the most part. And they're going to be about the same as an FHA loan. Again, the only difference is that you don't have to pay upfront mortgage insurance and a monthly mortgage insurance. However, they do have a funding fee. If they are not disabled, they have a funding fee to pay. And it just depends. If they're still in the service, chances are they're going to be paying a VA funding fee. And it depends on how many times you've used your VA benefits to purchase a house, that they'll tell you exactly how much that's going to be. But if you are disabled, I know that when you get discharged, even if you have a little bit of a disability, it's a bare minimum 10% disability, you will never have to pay a VA funding fee. Closing costs are comparable with other financing types. However, there are some fees that are non-allowable for a veteran to pay. So us as a lender, we have to cover it. And the loans are assumable.